Alaska Airlines, Verizon, and American Express all reporting earnings before the end of the week. And next week, some of the first big tech names are set to report, including Apple, Microsoft, and Tesla. Our next guest has recommendations for how investors could be using options during earnings season. Sean McLaughlin, All-Star Chart's chief option strategist, joins us now for an options segment sponsored by Tasty Trade. Sean, great to have you here. Just level set with me. How great does your investor hygiene have to be in order to engage in options trading during earnings season?
Well, that's an interesting way of putting it. Investor hygiene. I like that. The great thing about options trading and using options for perhaps longer term investments is that you can clearly define your risks in a way that a stock trader cannot. And at earnings season, this is incredibly important because think about this. You're long a stock heading into earnings, you're bullish, you think that the stock is going to pop. And maybe you have a stop loss order working that will take you out if the stock trades down to your price and it could get you out. Well, what happens if the earnings event happens and the next morning the stock gaps 20% lower, far below your stop loss order? The stock trader is going to get hurt dramatically in that situation because they have no out. They have to get out at the opening price the next day, which is whatever that price is, and it could be way below their stop. Meanwhile, the options trader who played that same trade, maybe just purchasing long calls, their risk is defined. They can't lose any more than what they paid for the premium of those call options. And so they're going to be in a much better position and a position of strength to ride out any volatility. Now, if they get it right, both the stock trader and the options trader are winning, but the options trader is getting better returns relative to the amount of risk they took. So for me, options is the way to play earnings.
You know, Sean, when it comes to some of the strategy behind options trading, when it comes to earnings season, is there a different strategy that should be employed, just given the fact that we are likely to see a more volatile ride for some of these stocks?
Well, there's a lot of people that like to trade earnings in a way where they put on trades right in front of the event, maybe the night, the close, right at the close before the afternoon announcement, and they will sell premium. And what they'll do is they'll sell what's called a delta neutral spread, right? They'll sell some out of the money calls, they'll sell some out of the money puts, and all they're really betting on is the collapse of the options premiums coming out of the event. Because after the event happens, assuming there's no drastic move in the stock, then the fear that priced extra premium in those options will come out, and then the seller of those options can buy them back the next day, presumably at a cheaper price. There's a lot of people that trade earnings events that way. I do not. The way I look at earnings events is I use them as a catalyst for whatever thesis I have on the underlying. So for example, we're currently long NVIDIA. We got long NVIDIA a couple of weeks ago. We're in an option spread in that. And we bought NVIDIA not because of earnings, but because we like the setup. But we saw that earnings are on the horizon coming up. And I'm using earnings as the catalyst that could continue pushing the stock higher, because the way I learned it is surprises, if you want to call them earning surprises, they tend to happen, they tend to unfold in the direction of the underlying trend. And NVIDIA has been nothing but up, more or less, for the past year. And so odds are, if there's an earnings surprise, it's likely to be higher. And I'm positioned for that, and I'll win if we go higher. But the important part is if NVIDIA goes the other direction, I have a defined risk trade on. I already know the most I can lose, and I'm comfortable with that. I've sized my position in a way that if I lose 100% of the premium, my portfolio is only going to lose about 1%. No big deal. I could come back from that.
You got the hedging baked in, Sean. Thank you so much for joining us. Really appreciate it.
You're welcome. Thanks for having me.
We're going to have all your markets action ahead, so stay tuned for more. You're watching Catalysts.